David Smith, manager of Henderson High Income Trust. Perhaps we could start with the UK equity markets and how they've performed over the last 3 months.
Equity markets have been very strong so far this year in 2015, and that's really been driven by the ECB's announcement over quantitative easing. You would have seen the FTSE 100 has now gone through its all-time relative high. And I think if you look at last year, where the UK market lagged the likes of the US, and that was really on fears over Europe, one of the UK's biggest trading partners, and that fear over economic growth there. And I think what the ECB has done is really abated some of those fears and concerns.
And how has Henderson High Income performed in this environment?
The trust has performed well. The NAV total return is up 7.4% to the end of February. And given the positive market backdrop in equities, the trust has benefited from the overweight we have in equities relative to bonds, and also the element of gearing we have within the trust. I think within the equity portfolio, we've seen good upside from the media sector, in particular Pearson and Money Supermarket. Both of those companies have reported very strong results in the last 2 months.
And have you made any significant purchases or disposals?
We've been selling down our position in Catlin, the Lloyd's insurer. It was bid for by one of its US competitors end of last year. We feel the price is fully reflected now, fully reflective of that bid. So we've been using those proceeds to reinvest elsewhere in the financial sector. One of the stocks we've been adding to our position is in Lloyd's. You would have seen at their most recent results, they've now returned to the dividend register for the first time in 7 years. And we believe that as the economy recovers, a lot of that excess cash flow will come through and materially increase those cash returns to shareholders.
And what is your outlook for the coming period?
Well, I think in the shorter term you could see increased volatility in the equity markets, and I think that would be driven by uncertainty around the UK general election, which party or parties are likely to come into power really. But I think as fund managers we will look at that volatility as a bit of an opportunity to pick up some of the holdings that we do particularly like on maybe cheaper valuations really. I think longer term, I think the equity I'm pretty positive on the equity markets. I think interest rates are likely to stay lower for longer. I think the economic growth in developed markets certainly are looking more robust. The outlook for the consumer, given cheaper oil, cheaper energy bills, cheaper food prices are good. And actually corporate balance sheets are strong. So putting that together, I think longer term I would be more positive on equity markets.
David Smith, thank you very much.
Thank you.